This page states that the article and all related content are the intellectual property of Ingritech LLC, with all rights reserved. Any reproduction, distribution, or use without express written consent is prohibited. Citations and use of content must comply with academic referencing standards and include proper attribution. The presentation is a case study research on applying machine learning to support investment decisions in the Vietnamese stock market. This research was implemented and reported by Mr. Nguyen Xuan Hien and owned by Ingritech LLC. The Vietnamese stock market has seen rapid development since 2000, becoming a vital part of the economy. While transparency is increasing, investment success depends heavily on analytical knowledge. The challenge is how investors can make more informed decisions in a dynamic market. Artificial intelligence, AI, particularly machine learning, ML, and data mining, offers powerful tools for financial analysis. The proposed solution leverages machine learning for smarter investment insights. The core idea is to combine support vector machines, SVM, a robust supervised machine learning algorithm for classification, with the beta coefficient, a key indicator of a stock's volatility relative to the overall market. The goal is to empower investors by classifying HSX stocks based on beta values, offering a clearer understanding of individual stock risk profiles and overall market systemic risk trends. The methodology involves data collection of historical trading data for all listed stocks on HSX and VN Index data from CAFE-F, spanning July 28, 2000, to April 29, 2025. Data preprocessing includes cleaning and splitting data into training and testing sets, calculating daily returns, and calculating beta coefficients for each stock. Stocks are then classified based on their beta values, e.g., defensive, market-sensitive, aggressive. The methodology continues with training a linear SVM model to classify stocks using beta as the primary feature. Model evaluation is done using metrics like precision, recall, and F1 score. The approach is novel due to its unique fusion of SVM's classification power with beta coefficients, moving beyond common technical indicator-based ML approaches in the Vietnamese context. It focuses on systemic risk assessment indirectly by classifying stocks by risk profiles, offering insights into broader market risk rather than direct price prediction. The application is specifically tailored to the characteristics and data of the Vietnamese stock market, HSX. The SVM model achieved high accuracy, 0.9845, in classifying stocks based on their beta coefficients. It successfully identified effective decision boundaries for different beta-based stock categories: Class 1, low beta, defensive, at 1.20. The confusion matrix showed a low misclassification rate. The model empowers investors by providing a data-driven tool to assess individual stock risk profiles and understand potential shifts in market systemic risk. It helps in improved portfolio construction by aligning stock selection with an investor's risk appetite. Furthermore, it serves as a foundation for further research into more sophisticated predictive models for the Vietnamese market. Limitations include subjectivity in sample selection, which can influence model performance. Beta is calculated from historical data and does not guarantee future performance. The model's classification is primarily based on a single feature, beta, while other factors also impact stock movements. The current model is more effective for indicating systemic risk trends than for individual stock picking for investment portfolios. Moving on to future directions, it's important to consider some areas for improvement and expansion. Firstly, the subjectivity in sample selection can influence model performance. Secondly, beta is calculated from historical data, and it doesn't guarantee future performance. Thirdly, our current model primarily focuses on beta as a single feature, but other factors also impact stock movements, which could be incorporated in the future. Lastly, while effective, the current model is better for indicating systemic risk trends rather than for individual stock picking for investment portfolios. Future research can involve horizontal expansion by experimenting with different data splits, incorporating additional features, e.g., RSI, P/E ratio, for more robust portfolio selection models, and exploring clustering techniques, e.g., K-means, for unsupervised stock grouping. Vertical expansion of the research includes combining the model with regression models to forecast beta values, short and long-term, and using predicted beta values with SVM for more dynamic stock classification and risk assessment. The researcher can be contacted at Handphone, Zalo, Viber, Signal, 84,933,023,468 or email, heanx2k4@gmail.com.